Hello friends, today we'll be discussing about international taxation and specifically focusing on non-resident. In the domestic tax law, there are various heads of income and that head of income has various categories of income, and depending on those categories of income, the tax rate is applicable under the domestic law. Now, under the domestic law, there are certain tax rates. Under the tax treaty that India has executed with various countries, there are certain separate tax rates. For a non-resident, they have to make a choice between the tax treaty or the domestic law. Now, we will be today focusing on business income and a little bit of royalty and fees for technical services. Under business income, under the domestic law, there are two sets of provisions which govern the taxability. One set is related to having a business connection in India. The concept of business connection is very akin to the concept of a permanent establishment, and it is largely in lines with what internationally is understood as a permanent establishment. India has been an early adopter of the BEPS Action 1, which relates to the taxability under the significant economic presence provisions. Whereas the global phenomenon around the SEP provisions is largely related to digital businesses. The way the provision is worded in the domestic law, it is having a wider ambit, and largely it also covers organizations who just trade in goods with India. So instead of just having the wordings of the provision to cover digital services, the way the provision has been worded, it is wide enough to cover even goods transactions. So with that background, the threshold that has been put for the SEP provisions applicability has been at INR 20 million. That's a little below 250,000 US dollars. And if a non-resident transacts with India for a value exceeding that amount, the significant economic provisions kick in. Let's take this as an example. A German exporter is exporting capital goods, machinery to an Indian importer. That Indian importer is buying this machinery worth say INR 50 million. When the Indian importer wants to make payment for this machinery, the Indian importer would have to consider the applicability of the withholding provisions. Those withholding provisions, read with the significant economic presence provisions of the Income Tax Act, necessarily require the Indian importer to have a withholding done on the payment that is being made to the German exporter. In order for the German exporter not to be covered by the significant economic provisions, the German exporter would have to provide a copy of the tax residency certificate of the German exporter issued by the German tax authority. And this is a precondition for claiming the treaty benefit under the India-German tax treaty. The second thing is that if the tax treaty does not have 5 elements, which is the name of the taxpayer, the German taxpayer, the address of the German taxpayer, the tax identification number, the status, which is either it's an individual or a corporate, and the year for which the tax residency certificate is valid, then the German exporter would also have to furnish a copy of Form 10F, which is a specified form which has to be furnished for claiming that benefit under the treaty. From 1st October 2023, the furnishing of this Form 10F has been made digital, which means that the German exporter in our example has to obtain a permanent account number, which is a PAN issued by the Indian income tax authorities. They have to register themselves on the income tax portal and furnish this Form 10F. There's a rule in the income tax rules, which is Rule 21AB, which governs when a Form 10F has to be issued. So as we discussed, if the 5 characteristics or the 5 particulars of the non-resident is not present in the tax residency certificate, then the non-resident has to compulsorily submit Form 10F. If the tax residency certificate issued by the non-resident jurisdiction has all these 5 characteristics, which is the name, the TIN, the address, the status, and the year. If these 5 particulars are already there in the tax residency certificate, then the non-resident is not required to furnish Form 10F. However, largely not all of the tax residency certificates issued by non-resident jurisdictions contain all these particulars. And that's why this change that is coming in from the 1st of October will have a significant impact on how non-residents are doing business with India. The process to furnish Form 10F online is going to kick in from the 1st of October 2023 unless it is further relaxed. It has already been relaxed twice. That's it from this issue of our International Tax Bite. I hope that this content has brought some value to you and you would have enjoyed listening to this. Thank you.